Hi. As you can see, they've let me out of my hole here in our Virginia office. I'm out here in our open area where I prefer to work. I got my stand-up desk. Things are kind of getting back to a new normal, I guess you could say it. The first 4 to 5 weeks of this crisis, I spent all my time locked in my office. That's kind of the signal to everybody here. Do not disturb. Don't let calls through. Don't interrupt me until I come out, and then I'll take care of things. And we were stress testing every one of our investment models. We were looking at the investments we owned, plus those we were looking at buying. We were going through all sorts of scenarios. I was on the phone constantly with our Rick and our portfolio management team, just trying to go through things of how we're positioned. And I provided quite a few updates from there. Now I've finally been allowed to emerge, and before I get any angry emails, the only people that are allowed in this office are those who work for us that are family members. Figure we're going to be exposed whether it's at home or here, and we're a lot more efficient here. Today I wanted to go through the economic environment, where we're at in the stock market, and then look at how our investment models are set to handle what's going to be the next phase of this crisis. And it'll kind of give us a better idea of where to go. Now, first up, our economic model, that's literally been the star of this. Before even the coronavirus was a thing, it had already gotten concerned about the economy. It pulled money out of the market. It went bearish at the beginning of 2019. And what's interesting about this sharp economic slowdown that we're seeing is it'll actually make it a little bit easier to get a hook at the bottom to get us back into bullish mode, whatever that may be. But that's the key, is we're going to be trusting the data, not people's opinions that you see on Wall Street. Now, as we've gone through this, here's a chart of the investor emotions that people tend to feel as we go through this. And what's key here is everybody goes through this cycle differently. You may be at a different spot than your husband or wife or your advisor or anybody else. You're going to see different phases of this cycle. And my main point of this is we all go through this, but as a consensus, you see the stock market going through this. And as we look at it right now, I would argue that we're probably only in the denial phase. You know, a lot of people have called the bottom and said we're heading back up. And as we talk through this, I'll explain why I believe we are not quite at the bottom and haven't really seen the worst of things just yet. But looking ahead, here's a chart of, I called it the short-term outlook. It's the way our brains have focused. And going all the way back to 2009, what we've seen is every time the market's fallen a little bit, you've been rewarded by buying the dips. And we're going through that again. The stock market has literally retraced half of what it lost going in, since the peak in February. But what will happen is when buying the dip doesn't work, and we walked through it in the early days of the cycle when the market dropped 20% and then 25 and then 30, then ultimately 35%, buying the dip finally worked. But you saw a lot of people buying and then getting out and selling at a loss. And what's important to keep in mind is our brains will focus on what it remembers. And right now what's still being reinforced is you should buy the dip. Every time the market goes down, you should buy. And as I've argued, that will work until it doesn't. Looking at the next chart, and this is where I really have an issue with what I'm hearing on TV and reading in the financial media, is I don't think stocks ever even really got to an attractive valuation. If you want to look at earnings, where we're at, we see earnings constantly being revised downward. Based on my experience looking at these things, we're looking at probably a 20 to 30% drop in earnings, which means stocks are still significantly overvalued. Then the argument becomes, what type of multiple or price earnings ratio do you want to apply to that? And I don't see it. I don't see where we're going to come out of this and people are going to go right back to paying 21 times earnings, and we're going to see earnings back to where they were at the beginning of the year. And so to me, that means stocks are probably overvalued. And if these don't belong in your portfolio, and we'll have a little bit more on that later, it's probably a good time to be looking to sell things as the market rallies, especially where we're at right now at that 50% retracement level. Now, here's another chart I showed of looking at past bear markets. This was literally the fastest 30% drop we've ever seen, which means we at SEM have never tested in such an environment. And what's encouraging to us is all of our systems performed exactly as we expected them to do. And what's important though, looking at this is, and I've pointed this out in a couple of my other updates, is in all of these other sharp bear markets, we always had a recession except for 1987, but even 1987 was a very long recovery. So again, I think we're in the middle of the second phase right now of this sell-off. And what we've seen is that we had the panic. Oh my gosh, everything's shut down. Just get me out of stocks. Now we've had the relief. The curves have seemed to flatten out. It's not, the deaths haven't been as bad as we thought, which, as a side note, is probably the result of the panic and everything shutting down, according to the doctors and medical experts that I've talked to. But we'll never know because we shut things down. But the next phase is going to be, okay, what are the actual damages to the economy, to corporate earnings? How long does it take to get the economy reopened? And I think based on my experience from 2001, 2002, as well as 2008 and 2009, is we're in for that kind of reality check where you see another leg down in the market. And so that's why if you don't belong in stocks, if maybe you were a little bit too overexposed or you've been wanting to get rid of some things, this rally is definitely a good chance to get into it. And taking an even bigger step back, looking at the market since the 1990s is interesting. Is here's a chart we've been showing throughout the bull market is most people don't need help with their portfolios until you see a big sell-off like that. And we're thankful to the clients we've had. We've had some clients going all the way back to 1994. It's great. They understand how we work. We've had other clients and advisors be with us since 2000, 2002, so they know how it is, and then others 2008, 2009. But for some advisors and clients, this is their first experience going through a really bad market. And what's important to keep in mind is the bear market is always shorter in duration, but it's definitely more scary. And it's not just the loss that you see in the stock market, it's the time of going through it. So as the economy reopens, and if things don't go up like a rocket ship like the president is predicting, we're going to be in a situation where it's not going to be very pleasant, and then you start to get worn down. So it's definitely not too late to act on getting your portfolio over to somebody like SEM who can watch the market on a daily basis and then redeploy based on what's happening in the market or take more money off the table, again, based on what's happening. And I've been waiting for several years, and I've shown the next chart, which is what we call the Buffett indicator. Warren Buffett said, mathematically the best way to look at stock valuations is to take the total value of your stock market and divide it by your total economy. So market capitalization divided by GDP, because mathematically over the long run, you can't have the stock market worth more than your economy, because the way the numbers work is all the earnings, even those from overseas for US-based companies, end up filtering into GDP. So there's a time to buy and there's a time to sell. And notice Warren Buffett hasn't been out in the media saying, back up the truck, I'm buying, like he was in 2008. And this is a regression showing the strong predictive value of the Buffett indicator. This is way better than price earnings. It's even a little bit better than price to sales, which also is saying stocks are not at an attractive value yet. We want to wait until we see the stock capitalization below the total of the economy. That's when you back up the truck to buy stocks. So what that means is if you're deciding to hold on to stocks today, your returns for the next 10 years are likely to be somewhere less than 5%. We want to wait to back up the truck and buy stocks to when we can expect double-digit returns. We're not there yet. I think we will as we go through this cycle. And the other thing to keep in mind with this chart is that's still using the fourth quarter 2019 economic data and the March 31st prices, which is pretty much the lows for right now. So we're just not there, and valuations aren't favorable. Now, the question is, are you in the right portfolio? And the next chart shows the different personalities that people have. And what we found is people who score more towards the conservative side tend to be more emotional with their decision. Now, that's not bad. I score down there. I tend to be more emotional, but I overcome that by using mechanical models and doing things that can help me adjust for those emotions. And so at our website, semwealth.com, there's a box at the top that has a risk questionnaire. I'd encourage you to take it. We get the results, we send them to your advisor, and we say, let's take a look at your portfolio. And that'll tell you whether you're with SEM now or if you have outside assets of adjustments you could be making to your account. Now, the key, though, to all of this, and this is what I've said to people, whoever asks me, well, what should I do? Is it depends on your financial plan and your cash flow strategy first. So if you don't have a financial plan and a cash flow strategy, we can't give you investment advice. And that's why we work with advisors who develop those things. And I always say, if your financial plan and your cash flow strategy hasn't changed, and obviously with this crisis, a lot of people's situations have changed, and we do need to make adjustments, not only to what you have at SEM, but also what you have outside of SEM. So take the questionnaire, we send it to your advisor, and then we work with them to decide, well, what's a good portfolio allocation? Now, when we get to there at SEM, we look at the different investment models that we have as kind of a different part of your overall portfolio. We call them buckets. And there's a wide range of different things that we can do. And when we put those together inside a single portfolio, inside one account, you get these neat things where different things are working at different times. It's like having 3 different investment managers inside of there. And also we pull in outside investment managers into our models. So you get a strong diversification when you come to SEM. It's not like you're going to a singular investment research firm. You're getting this wide range of research and a very sophisticated portfolio that's set up for you. Now, the way we look at it, and the question is why we use a behavioral approach. It's pretty simple. There's times when the market's overvalued, and there's the times where it's undervalued, and it's based on people getting too excited about growth and then too pessimistic about growth. And based on all the valuation metrics, we're not quite there yet. We still have some money invested. We're not pulling everything out of the market, but we're only kind of back to that trend line. Almost always the best buying opportunities come when you get below that trend line. And as I said, my guess is that we're heading there. But the nice thing is, none of these opinions that I've shared enter into our investment decisions. In fact, if you look at where we're positioned today, our tactical systems have started to buy back in. Now, they're not calling the bottom. They're just saying things have gotten stretched and we've kind of stabilized a little bit where it's okay to buy some bonds. We're looking at buying things that the Fed is buying. They're buying investment grade bonds, and they're buying bonds down to a BB rating, which is just basically the highest rated junk bonds out there. They're not buying the junkiest of the junk. And so the things that we've bought in tactical bond, income allocator, cornerstone bond, those are things that the Fed is also buying, but we also expect this to maybe not be the great trade that we've been waiting for. It's just a short-term chance to make money, because when you sit in money market, you're making zero. Valuations got a little more attractive. They bought. You look at the dynamics. They have a whole bunch of money on the table waiting for the economy to turn. But where they're positioned has been so nice. If you look at any of our dynamic portfolios, going all the way back to the beginning of 2019, they've really been the star of SEM and what they've been able to do. When the economy hooks, they're going to be ready to get in, but they're in a nice defensive position right now. And I'll talk about some of the ways that they'll come out of this here in just a minute. But then you look at our what we call strategic. I call them strategic with an asterisk or strategic with a twist. The core portfolio is adjusted quarterly, but during this crisis, we've been able to add daily and weekly monitoring where we can look at the trends in the market and step out of the market to the lower band of each of those programs. And we have balanced growth and what we call max to adjust the allocations as needed. They're about halfway out. So they're right in between where they should be. They actually sold into the rally that we saw. And so now it literally can go either way. And so I put together this flow chart to show our roadmap. And this is key. We've been through this before. We've been battle tested. And we know based on our systems, and that's what I spent the last 4 or 5 weeks in my office here in Virginia, of going through all the different scenarios that can happen. And this is a simplified version of what we can see is, if we are in the V bottom, that's where everybody says, we had this big shock. Now everything's going to go right back to the races, back to where we were at in January 2020. All right, great. I would love to see that happen. If that is, we've already started to see the first phase of that, which is we're going to start buying bonds and tactical bond, cornerstone bond income allocator. Dynamic income actually uses outside managers who have also started to step back into the market. But all of them agree. All of them have been around since the 90s, some of them since the 80s. And they're all saying this is just a short-term blip. We're going to have another down leg. But none of them say it's what we're doing is based on that opinion. They're literally following their systems that they've always followed. And that's the beauty of all of our income systems. Again, tactical bond, income allocator, dynamic income. They're stepping in, but most likely they're going to have to pull back out because we're going to see that down leg. But say we're wrong. We're going to see the economy hook. Dynamic systems get back into the market. The strategic Ameriguard and Cornerstone models jump back in all the way. They're already at their half allocation. And what did we really give up? We gave a little bit of the rally. But here's the thing. If you're in that type of portfolio, if you're doing this by yourself and you have to be right, that's a scary position to be in because I've seen this happen. This economic shock is going to be worse than we've ever seen in any of our investment careers or any of our experience. There's no way the economy comes back. What the Fed is doing is they're just trying to stop the bleeding. They're not actually doing things that are going to create long-term opportunities yet. I think we're going to get there. So if you're wrong, if you're sticking to what your investments are in a buy and hold strategy, and we do see that down leg, the scary part is when all that stimulus isn't working and it's taking longer to reopen the economy. And all of a sudden you're going through these losses and you don't know what to do. So this is a perfect opportunity to go from that buy and hold strategy, whether you're an advisor using one of these big name firms who you thought would protect you, or you're an individual, especially if you're over 59 and a half, you're in the thrift savings plan with the federal government or whatever your employer plan is, and you're able to roll some of that money out. Talk to your advisor. This is a great opportunity to get that money into something that has a plan to go either direction because that's critical. We've been through this before. We don't have to be right at SEM. We've protected our clients on the downside, and now we're stepping back in, but we have the finger on the button to get right back out. Because we've been through this before. We know there's no easy answers to this. It's a scary situation, and it's something that we want to be able to help you with. So whether you're an advisor and you're brand new to us, or you're just finding this shared with you from some other means, we would love to talk to you about ways that you could take advantage of this comeback we've had in the market so that you don't have to be right about that V recovery. Again, we hope that's the case. But we want you to be able to focus on, if you're an advisor helping clients, if you're an investor, just staying healthy. That's key. We're going to get through this. I'm a big believer in the American spirit. I know we're going to come up with a vaccine, ways to test, but it's going to take time. And I don't want to have to be right. One thing we've always said, Rick told me this from the very beginning, hope is not a strategy. So at SEM, we hope for the best, but we also plan for the worst. And we have a sophisticated set of investment models that makes it so we don't have to be right, and you're really not giving up that much by using SEM. So we encourage you, check out our website, semwealth.com. Take our risk questionnaire if you're an investor. If you need to find an advisor, let us know. We have a Find My Advisor link under the Investor tab. But most of all, stay healthy. We're almost through this. I could feel it. When the economy opens up, I'm excited to get out there, but I don't know when that'll be, and we need to take care of your investments.